Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. And I'm joined by Evan Coffey, Investment Analyst on the Asset Management team. So what are we talking about today, Evan?
Well, since the last time we met on Market Insights, we've gotten some important macroeconomic data that has given us a window into what the Fed might do for the rest of the year and what the rate environment might be for 2026. It's also given us a sense of direction as asset managers in terms of positioning for our clients. But I want to start with the numbers before we get into positioning. We got reports from the BLS in both August and the beginning of September that help shape the current labor environment today. On the first Friday in September, we got a non-farm payrolls report. We saw a net change in employment increase by just 22,000 jobs. This was after 79,000 in July and expectations of 75,000. Net revisions weren't as detrimental as that beginning of August report where we saw net revisions down 258,000. This time it was just 21,000 down from the prior 3 months, but that 3-month average has now slowed to 29,000. I think more importantly, we now also saw a net contraction in jobs in the month of June. Prior to the non-farm payrolls report, the BLS released their monthly JOLTS report. This is the openings, quits, layoffs report for the year total. And we saw this number come in terms of openings at 7.18 million, confirming the U.S. economy now has the fewest job openings in almost a year. It also confirmed that for the first time in more than 4 years, there are fewer open jobs than there are job seekers, signaled by a vacancies to unemployment ratio of below 1. And this is the first time since 2021 this has happened. So what does all this mean for us? What does this mean for the economy? Well, these reports show a labor market that is weakening, but not completely collapsing. Right now, it feels like policy uncertainty has led to a sense of paralysis rather than just a big wave of layoffs. In other words, companies aren't firing, they're just not hiring. So with these latest labor reports, it virtually guarantees a rate cut this week from the Federal Reserve. They meet on Wednesday. The CME FedWatch tool is showing a 94.5% chance that we get a quarter-point rate cut and about a 5% chance that we get a 50 basis point cut, combined to just under 100% that we get some sort of cut. So my question to you is, the last time we met here on Market Insights in August, we tried to flesh out what the Fed might do in September. And I think that you were spot on, agreeing with market sentiment that we were going to get a 25 basis point cut here in September. And it looks like that's what we're going to get. But my question to you is not about this week, but the next 2 meetings and the final 2 meetings of 2025 in October and December. What will the Fed do? What should they do after receiving these labor reports in September and August?
Okay, it's a great question because there's a lot of concern out there right now about the slowing economy. And as your point, there's not a lot of hiring that's going on, but there's also not a lot of firing that's going on either. The economy is slowing, but I think the probability of recession remains very low. I would put a probability of recession less than 10%, to be honest with you. Because if you take a look at, projections for economic output, and you take a look at, business activity, you take a look at corporate earnings, this is an economy that's continuing to chug along. This is not an economy that is in dire need of support and monetary policy easing, but that's what we're going to get. I mean, it's very likely that we're going to see, it's almost certain that we're going to see at least 25 basis points from the Fed at the September meeting. And it's very reasonable to expect that we will see another 25 basis points at the November meeting and then another 25 basis points at the December meeting. Now, this is what's likely to happen, but I don't think the economy needs it. And the reason I say that is because when you take a look at the inflation data, inflation is not slowing. I mean, we had the inflation rate, it peaked in 2022. It was above 6% on the core. It was approaching 9% on the headline basis. Yes, it came down below 3% on the CPI, down below 2% in some cases on some of the PCE measures, but it has been rising the last few months. It is very unusual to have a Federal Reserve cutting interest rates, an economy that is still expanding with rising inflation pressures. So while everyone is focused on the potential recession shiny object, the real issue I see coming down the pike is an inflation problem.
Well, I think that's That alludes to our final segment today, so I'm glad you brought that up. But I wanna ask you a question about that inflation problem that we may see occur. So do you think that this could also stem from kind of a wealth effect scenario where if they do lower rates, we're going to get a boost in asset values and subsequently make people, the consumer, feel wealthier? And I think that could trigger spending. As you said, CPI bumped up to 2.9% on the headline report that we got last week. So do you think that not only could we see tariff implications and inflation measures previously, but then post-cut, the idea that rates are coming down and the consumer is wealthier or they feel wealthier, is that a problem to you?
Yeah, I mean, there's no shortage of liquidity that's out there in the marketplace. You take a look at the S&P 500, just trading at all-time highs. And you take a look at the gold price. It's taken a new leg up. It's pushing towards $37.50 per ounce. It struggled to get above $2,000 per ounce a few years ago, and here we are nearly doubling that a couple years later. And there is no shortage of liquidity out there. And we're talking about adding even more liquidity in an environment where we're already seeing a wealth effect, in an environment where we still have economic growth, an environment where corporate earnings are still growing at a double-digit year-over-year rate. If anything, we're looking at a situation where pricing pressures are going to accumulate. Yes, corporations have absorbed the increased costs of tariffs so far. And yes, there are components to the recent budget bill that went through Congress that are helping corporations extend absorbing those costs. But eventually they're going to get passed on to the consumer at a time when there's an abundant liquidity for the consumer to absorb that. And that doesn't sound like a recession to me. That sounds like higher prices to me.
Yeah.
And the question is that how much higher are those prices going to be? And how comfortable is the bond market going to be in an environment where we see steadily rising inflation?
Yeah. Well, you mentioned the S&P. This was a topic that we covered heavily on the last Market Insights, where the market was at. We're currently today sitting on the S&P at about 66.08. And, I want to dive back into that conversation that we had in August about concentration. We've got the macro backdrop now. We know where the labor market's at. We know where inflation's at. But even through all of this employment turmoil, stocks, again, as you said, knock on the door of all-time highs. Both the S&P and the tech-heavy NASDAQ have moved in lockstep over the past month, both up around 3.5%. And investors have continued to focus on those top names. Once again, we see 39.7% of the index in those top 10 names. And while some of them have lagged a little bit, we saw Nvidia, Microsoft, Meta all down for the last month, but others are up tremendous. Oracle, Broadcom, Tesla, up more than 15%. So generally the profile feels the same. We've got the concentration at the top. Those names are pulling the market along. 8 out of the top 12 names are up double digits year to date. And it feels like we're right where we were and right where we've been and right what we've been talking about here on Market Insights. So with this shift that we feel like we're getting in the economy, in the employment backdrop, and the inflation backdrop, and what the Fed might do going into the second half of the year, is there somewhere where investors can go and hide, per se, outside of those top 10 to 12 names in the S&P 500?
Yeah, you raise a really good point, because it's one of the things that I really worry about is that the S&P 500 is more concentrated today than it has ever been. You have a small group of mega cap names, primarily concentrated either in the tech sector directly or tech adjacent sectors like communication services, consumer discretionary. For you tech bubble fans out there, this is the old technology, media, and telecom from 25 years ago. History repeating itself. Now, these companies are making money, but the only problem is that they are trading at historically high valuations. And we get into a higher inflation environment, it's the profit margins for those companies are going to get squeezed. And when you're trading at 30 times, 40 times, 50 times plus earnings, any type of squeeze in profit margins can really take the wind out of the sails of these companies pretty fast. So you have a lot of people concentrated in a small number of tech names. If the winds change, that could be a real problem for that area of the market. Now, at more reasonable valuations, it's right to be optimistic on that area of the market, the growth areas of the market, and the inflation and a more inflationary environment. So artificial intelligence, healthcare technology, fintech, There's also a great opportunity on the value side of the market. What does well in an inflation environment? Value stocks, because they're trading at discounted multiples. You're getting a higher earnings yield for your investment relative to inflation. So it could be a time where we start to see value to come in more favor. Another area to keep an eye on going forward is, if we see greater inflationary pressures without a response from the Federal Reserve or fiscal policy, that implies a weaker dollar, which would benefit international stocks and emerging stocks. And, on the bond side, the key there is duration. You don't want to be long duration. You don't want to own 10-year and 30-year bonds, typically in a high inflation environment. You want to own shorter term bonds that are going to mature in 6 months or a year, because they're constantly resetting that rate. And then another area of the market, we already talked about gold and precious metals, but another area of the market that's worth keeping an eye on is the commodity space. Real assets. What does well in an environment of higher inflation? Companies and the areas where there's real assets like commodities. So that's another space to really keep an eye on here as we go forward.
Yeah, and I think you've provided investors and clients, advisors, a lot of good areas where they can go, because I think that this is a time where asset managers feel a little bit handcuffed, because on one side, you don't want to miss out on what we've seen the last 2 to 3 years since the 2022 bear market, which has just been a market that's up and to the right and super concentrated. But on the other hand, you don't want to pile in at the wrong time, right when we're topping, and get all of the downside. So I think you've provided, some good areas where investors can go to seek risk-adjusted returns. The final point and theme I want to get to, you touched on your probability of a recession, and I think that segues us well into this final activity I guess I want to do, which is I'm going to lay out 4 possible market scenarios for you. And I want you to give percentage probabilities on what what you think is most likely to happen and what is least likely to happen. So
all right.
This stems from a JP Morgan article that we've been discussing over the last few days. And their first scenario is the accelerating growth scenario. This is where both stocks and yields are up. For this to come to fruition, the weakness that we're seeing in the labor market has to be ephemeral. It has to be short-lived, and implications from tariffs are manageable. Uncertainty would be behind us, AI CapEx continues to boom, and the Fed would likely delay cuts. So this is the aggressive, accelerating growth scenario. Scenario 2 is still positive for stocks, but this time yields are falling. In this scenario, the economy is growing, but it's growing more slowly. Tariff implications may be heavier on companies, but they eat those costs. They don't pass them on to the consumer. The consumer still continues to spend. Inflation, remains largely in check, and markets will largely drift higher with yields coming lower and the Fed likely cutting modestly. So this is the growing but slowing scenario. Scenario 3 is what you alluded to before, which is the recession scenario. Both stocks and yields are down. Uncertainty around costs in the labor market rise. This reduces CapEx and hiring. And, as I said, unemployment rises. Consumers pull back their spending. This is basically a worst case scenario. Stocks are tumbling and the economy is entering a full-blown recession. Finally, the 4th scenario is a scenario of stagflation, where yields are up and stocks are down. Inflation starts to pick up once again due to tariffs, due to policy changes, and we see a weakening labor market as well, with reduced consumption. Growth falters in this scenario, but the economy avoids recession, and rather than cutting, the Fed does a complete 180, and they start to hike rates. This causes yields to go above 5%, and as I said, we see a stagflation scenario. So I've laid out those 4 scenarios. We'll test if you kept up with me there. But what do you think is most probable out of those 4 scenarios? What is the greatest likelihood of situation that we have for 2026 or the rest of 2025?
All right, it's a great question. So I'm going to try to remember those 4 scenarios, and I'm going to take a lead here with the steady as she goes. Steady as she goes is the market environment that we've been operating in effectively since the financial crisis. I mean, have we had some blips along the way? European debt crisis, oil market collapse, onset of COVID, 2022 inflation. Absolutely. That's the environment that we've been in, but I would assign roughly a 10% probability that we're going to stay in an environment like that. Conditions have changed. We have an economy that continues to grow, but there's a lot more uncertainty around pricing going forward. And there's a lot more uncertainty in terms of global trade and the way the economy is going to evolve going forward. So it's been a great steady as she goes environment for the last 15 years, but I suspect that that's likely in the rearview mirror. So I'm going to assign a 10% probability to that first outcome. The second one I'm going to touch on briefly, recession. I would assign less than a 5% probability that we have a recession. If we do have a recession, it's likely to be mild, it's likely to be short-lived. And the reason I say that is because you find me a policymaker in Washington, D.C. that is willing to raise taxes, that is willing to cut spending, that is willing to raise interest rates. I don't see any of that right now on any side of the political aisle. There is a want to lower taxes, to increase spending, and to lower interest rates. And all of those things lead to a non-recession scenario, particularly when economic growth remains strong, corporate profits are growing at a double-digit rate, and we have all the stimulus that's coming into the economy. So if we do have a recession, it's likely to be mild and short-lived. So less than 5% on the recession. So that goes to scenario 3, accelerating growth. All of the conditions are there for accelerating growth. All of those things I just mentioned, lower taxes, higher spending, cuts in interest rates. So that's kind of the sweet spot. I would probably assign about a 35% probability to that scenario where, we can have economic growth, but inflation remains under control. But my highest probability scenario is the higher inflation scenario, the inflation uprising scenario, because that is the conditions, that is the situation we're fostering right now. And part of it is a byproduct of what I refer to as secular market cycles. We see time and time again throughout history that policymakers are fighting the last battle. They're not fighting the battle ahead of them. It has been nearly 50 years now since we've had a sustained bad inflation problem in the United States from 1968 to 1982. The battle that everybody is fighting right now is this mindset of, we got a battle against inflation. We don't want another financial crisis, lower interest rates, stimulate growth. Inflation, we don't have to worry about that. The last time we had that attitude in this country was in the mid-1960s and the early 1970s, and we saw what that brought us. That's the attitude that we have here today. A focus on stimulating growth and not really worrying about the inflation implications, which increases the probability that that's where we're going to be because there's too much stimulus coming into an economy that's already doing as well as it is.
Well, I appreciate you keeping up with the activity there. It sounds like stagflation scenario, high inflation, weakness in the labor market is the route that Eric's going. I think we covered a lot of good ground today. We started with that macro backdrop, hit on the weakness in the labor market, and subsequently a potential for inflation later on, what the Fed might do because of that. We covered areas where you might be able to go as an investor with this immense concentration at the top of the S&P, and we finished with that great activity where you laid out what you think the most likely scenario for our economy is. So, Eric, thank you.
Thank you, Evan. And thank you for joining us for this latest Market Insight, and I look forward to seeing you again soon.